A stop loss is supposed to define risk, but in real trading accounts, sometimes something strange happens. The stop moves, and when the stop moves, the plan is no longer in control. When researchers study retail trading accounts, they found something pretty interesting. About 70 to 80% of traders lose money in the market. Most people assume that the problem is strategy. But when you look inside the trade, something else often happens first. A small decision, and the stop moves first. When traders move their stop, it rarely feels like they're breaking a rule. It feels like adjusting to the market. The reasoning sounds familiar. The market just needs more room. I don't want to get wicked out. It will probably bounce here. You can't predict the market. You have to react to the market. From the trader's point of view, the adjustment feels reasonable. But psychologically, something important has already changed. Before entering the trade, the stop loss was just a part of the plan. It defines the risk. But once the trade moves against you, the situation changes. The loss stops being a theoretical thing. It becomes a real thing. And when the stop gets close, the decision inside the trade changes. The trader is no longer deciding how to execute the plan. Now the decision is simpler. Accept the loss or avoid it. Moving the stop delays that decision. But the risk hasn't disappeared. It simply moved further down the chart. There's a psychological reason why this happens. When the stop gets close, the brain doesn't experience a rule being executed. It experiences a loss about to happen. And the human brain is wired to avoid losses. Behavioral finance has a name for this. It's called loss aversion. Losses hurt more than gains feel good. So when the stop approaches, the brain starts solving a different problem. Not how to execute the trade, how to avoid the loss. And that's when the stop starts to move. The breakdown usually begins with a small adjustment. Move the stop a little lower. If the market keeps moving, the stop moves again. The plan is no longer guiding the trade. Discomfort is. The stop loss, which originally defined the risk, becomes something else. A way to delay accepting the loss. And once that shift happens, the structure of the trade disappears. Risk is no longer defined. It's expanding. And this is why execution discipline matters. Because in every trade, there are only two authorities. And I will say this over and over again because it's true. In every trade, there are only two authorities. The written trading plan or emotional reasoning in the moment. One of them always wins. When the stop moves, emotional reasoning has taken control of the trade. If you want to evaluate where execution tends to break down in your own trading plan, you can run through the Trader Gauge Execution Diagnostic. And I recommend that you do it. It only takes a couple of minutes. It's a short self-assessment designed to reveal the pressure points where traders, like yourself, begin abandoning their plan. After the diagnostic, there's also a structured tool, if you want it. It's available for traders who want to work on improving execution discipline further. You can find the diagnostic in the link below.